Hi, today we're looking at some more information regarding the banking system. More specifically, we're going to look at the various types of accounts that you can open in a bank or a credit union, and we'll talk about what those services are and what you get out of them. So we'll start off first by saying that anytime you put money into the bank, it's called a deposit, bank or credit union. And it's important to recognize, regardless of where you put your money, whether it's at a bank or a credit union, if it is being regulated by either the Federal Deposit Insurance Corporation or the National Credit Union Administration, your money is guaranteed up to $250,000. The FDIC regulates banks and the NCUA regulates credit unions. And as long as those two organizations are regulating your financial institution, then no matter what happens to that bank or credit union, you are guaranteed to get your money. So if you put your money in the bank and the bank goes out of business, you still get all of your money back. In the old days, before FDIC insurance, if a bank went out of business, then you lost everything. So it's safe to put your money in the bank, and that's why it makes sense to put at least some of your financial assets in the bank, because that way you can guarantee that you'll never lose it. One type of account that you can open up at a bank or credit union is called a checking account. And checking accounts allow you to be able to access your cash for purchases by writing a check or using a debit card. They allow you to be able to take money out of your account using an ATM machine. Checking accounts typically do not have very good interest rates. They're usually at 0% or very, very low, because the money that's in that account doesn't stay there for very long. And the kinds of service fees that you might pay for a checking account would include things like having to have a minimum balance. Banks may charge you a fee if you don't carry a certain amount of money in your bank account at any one time. So your bank may require a $50 balance, and if you don't have $50 in the checking account, then they'll charge you a fee. There may be fees for using an ATM, especially if you're using a different bank's ATM in order to access your funds. And there is what we call an NSF fee, or not sufficient fund fee. You would pay that if you wrote a check for an amount that was not in your bank account. When you write a check for more than what you have in your account, then we say that you bounce a check. And anytime you bounce a check, the bank will charge you a fee, unless you sign up for a NSF protection, in which case they may not charge you a fee, and they may just transfer money from a savings account to cover the balance if you didn't have enough in your account for the check you wrote. But again, you're going to have to pay for that kind of service. Another type of account would be a savings account. Savings accounts tend to have a higher rate of interest than checking because money in savings accounts stays in the savings account. You as a customer are not going to go to the bank and ask to get that money out very often, because the whole purpose of a savings account is to accumulate wealth. And so banks are able to then take your money and lend it to other people with the relative safety of knowing they don't have to give you that money anytime soon, and so they give you a higher rate of interest. It is a safe place to put your money because it's guaranteed by the FDIC or NCUA, and so you don't have to worry about losing value like you would if you were to buy stocks or a mutual fund or something like that. Savings accounts do provide a certain degree of liquidity because you can access that cash. You can transfer it to your checking account and be able to use it to purchase things relatively quickly. So it's a fairly liquid asset. Another type of asset would be the money market account. A money market account is sort of a hybrid. It's like a savings account. It's like a checking account. It tends to have a higher rate of interest than a savings account, certainly much higher than checking. But you do have to put in a larger deposit into the bank than you would for either a savings or checking account in order to get that higher rate of interest. One of the costs to the money market account is that you cannot withdraw as much money as you can out of a savings or checking account. You are limited in how much money you can access at any one time, and there's usually a limit to how many withdrawals you can make in a given month. So the money pretty much has to stay in that account, which is why they're giving you a higher rate of interest. Another option would be what we call a certificate of deposit, or a CD. A certificate of deposit is what we call a time deposit, meaning you put the money in the bank and promise the bank or credit union you're not going to ask for your money back until the time is up. And so a CD could be for 3 months, or 6 months, 9 months, 12 months, up to 24 months, 5 years. Whatever the time is that you sign up for, you have no access to your funds without having to pay a significant fee for an early withdrawal. The benefit of that, however, is that you tend to get a higher interest rate than you would if you were to leave it in your savings account or checking account. So you have to balance that desire for liquidity and desire for access to your money with the desire to have a higher rate of interest, which helps you generate more money. Like I said, there is a penalty for early withdrawal, so if you get a 6-month CD and you need the money within 4 months, you're going to have to pay a fee to the bank because the bank has lent your money to somebody with the expectation that you're not going to want it. And so when you come back and say, oops, I want my money now, the bank is in a bind, and so they're going to penalize you for that. It's also important to keep in mind that the longer you keep your money in a CD, the higher the rate of interest you'll receive. But keep in mind that when interest rates are in a period of rising, which they almost certainly will be in the relative near future to when I'm recording this, you don't want to lock yourself into a 5-year CD with a fixed rate of interest that won't change until 5 years is up. Because if you lock in now at, say, 1% interest, and next year they're offering CDs for 3% interest, you're stuck at 1%. And you're stuck at 1% until the time is up. So again, you have to balance that risk of a higher rate of interest now and will it go higher in the future or not to determine how long a CD you want to purchase. So this is an example of what a CD might look like. It indicates that this person has deposited $1,500 into their CD and that they're going to receive an interest rate of 5.61%, and they're going to get that after 18 months. So that's what a CD is all about. You don't have to use any of these accounts or options at a bank or credit union. You can be what's called unbanked. That is, you can trust that your money is safe in a mattress or in a jar or somewhere in your house, but you do have some costs that go along with that. One is you can't cash checks, or you certainly can't cash them easily. Banks will not cash a check for you unless you're a member or a customer. If they do, they usually charge you a fee, and that fee can be $5 or $10, and so you're losing a lot of value to get cash from a check because you're not a member of the bank. It also makes it virtually impossible to establish credits. If you choose to take out loans and use debt to purchase stuff, you're going to have a real hard time being able to do that if you don't have an established relationship with a financial institution to demonstrate your relative credit worthiness, that you know how to manage money and that you have assets in your name that the bank can get access to if you fail to pay a credit card bill. So being unbanked means no credit opportunities for you. It's going to be very difficult for you to make payments for things as well. You're going to have to actually carry cash to pay for anything because you won't have a check. You won't have a debit card, you won't have a credit card, and that means a much more difficult time for you to be able to make payments on things like your rent, or groceries, or a car, or a house, and so that makes your life more complicated. Your savings will not be safe because there is no insurance for your house. If you have cash in your house and your house burns down, you lose all your cash, plain and simple. And because you don't have credit, you won't be able to take out loans, which then leaves you in a situation where if you need access to money that you don't have yet, you need to take out a loan, the only alternative you have when you remain unbanked are the things we talked about in a previous class, like Title Max or a check cashing company, something like that, which we discussed is extraordinarily expensive and probably not a good financial decision. So those are the options that you have at a typical bank or credit union. And we'll talk about more about the banking industry in our next class.